Welcome to Kansas City. Today we're going to cover something that is very basic to the market, but you'd be surprised on how many brokers out there only know one segment of their market rather than all three of the big drivers of it. And that goes doubly so for small business owners. A lot of small business owners think all health coverage, health plans, health insurance is the exact same. And I'm here to tell you, no, it's not. There are massive differences between the three primary structures, and each of these structures have benefits, but they also have drawbacks. So we're going to cover the first one immediately here. Now, if you're reading this page, you can kind of already see the three that we're going to cover. We're going to cover fully insured, level funded, and self-funded with stop loss. Now, there is technically a fourth one, which is purely self-funded, but if you're listening to this conversation and you're running a purely self-funded program, I can probably not help you because you have at least 50,000 employees. So with that, the first market that most people associate with American health coverage, health insurance for a small business, even though it's actually a smaller portion of the business, I believe it's only around 25 million Americans are on this program, and around 150 million Americans are on these other two. What is it? It's fully insured. This is what most people think of when they think of health coverage for their employees, for their companies. What does that mean? Well, fully insured, you have this as your annual cost. Okay, well, how is that broken down? Well, frankly, it's not. All of the money goes in and goes into this big bucket. And the fully insured carrier says, you cut me a check, and I say thank you, you say thank you, and we go about our merry way. There's, in general, extremely limited reporting. In general, it's a black box. They take that in, and then they run their own business. Now, inside of these programs, it's actually split out much like it is inside of a level funded program. And that's the second category that we're going to cover. Level funded programs have grown about 800% in the last decade. And they've grown for a number of reasons. The biggest of which is transparency is the best disinfectant, in my opinion. If you want to have more transparency in American health plans, then you have to get reporting. The first thing that level funded plans have is it's actually the plan that's owned by the business owner. So they are entitled to all of the reporting. They get to know where every dollar inside of their spend is going. They get to see where the patterns are. They get to see where the abuses are. They get to see where their money is going. And with that, there's a structural advantage of level funding. Now that's a little deeper, but we're going to go a little top level to begin with. How is it split out? Tom, you said that the fully insured market utilizes the same kind of structure as the level funded. They just do it for themselves. That is correct. Here is the structure. On these plans, you're going to split it into about three categories. The first one is going to be the claims account. This is a large portion of what you're paying in every month to your provider or to your plan administrator. They're putting this money inside of a claims account for your group, for their claims as they come up. Fully insured is still doing the same thing. There's just a bigger pool of money. The second part is going to be administration or admin. This is the TPA, basically the company that you're hiring to administer the plan for the company on your behalf. This is ATA. This is a number of our competitors. Inside of this, there's also fees for your broker, their compensation, PPO access fees to get access to the pricing models for the discounts from the hospitals or for an RBP, repricer to take care of that. Then there's the other biggest category, which is called stop loss. These are the big categories inside of a level funded plan. All of these generally sit inside of a fully insured plan. You just don't see about it and you're not told about it because they treat it all as their money. In level funding, the claims account is the employer's money. This money right here with ATA, if it's not used during the plan year for claims, post run out, is all the employer's money. This is the structural advantage that has kept level funding in business for many decades. Now, some people see it as brand new and it's had a lot of growth. But in general, this is the big one. You get transparency, and if your group runs well, which most groups do historically, no guarantee of the future, that money stays with the employer. Beautiful. Now with this, it's level. So what does that mean? It means that the business owner pays the same amount each month, no matter what the claims are. Fantastic. If they have no claims or they have high claims, each month they pay the same. And then there's a true up at the end of the plan's run out period. Cool. Now, what's the difference between a level funded plan and a self-funded plan with stop loss? It's going to be what we just talked about. You're still going to have the fixed cost side of things. On the level funded side, this fixed cost is admin, broker fees, PPO fees, telemedicine, and then the majority generally is the stop loss fee or the stop loss coverage. The other side, on a self-funded plan, you're still going to have the same admin. You're still going to have your broker. You're still going to have your stop loss. So these fees are all the same. The difference is that instead of pre-funding your claims like you do in a level funded program, you're going to pay them as they come in, which means there's no true up at the end of the plan year where you have to wait until the end of the plan's run out period. Generally, it's a 12-24 contract, so an additional 12 months. This way you get the money back faster, or you actually never lose it, so you keep it inside of your company for a longer period of time. That's the big difference. The problem is that most really small business owners don't understand or have a advanced enough CFO to start doing this accrual accounting and then ballasting themselves for it over time. So in general, level funded programs work for companies of about 5 to about 250. And then self-funded with stop loss, people are going to argue with me, but these are broad strokes here, guys. Usually about 125 plus will run there. Now, there's a lot of crossover. It depends on how sophisticated their CFO is on how they handle the cash flow for this part of their plan's expenses. Because they're going to have an aggregate deductible. They're going to know their top cost. And they shouldn't hit their aggregate very often. But with that, they need to be able to fund that. So if they have a cash call for, on a 250 life group, $500,000, they have to be able to pony that up. With level funding, you don't have those cash calls. So it's easier for the finance department to manage. And that's why you get it in the mid-market, the 5 to 250. And somewhere around 125, they'll start going with that claims volatility and up until about maybe 10,000 at the smallest. And then they'll do a truly self-funded program where they do not have stop loss, or if they do, it's a weird type of reinsurance rider. Those are the three main categories. Realize fully insured is the easy button. There's no doubt about it. That's why people go there. They pay their money, they send their check in, and then they set it and forget it. Level funding is harder up front. But in general, it's better if you have a plan that qualifies, because this money in the claims account is yours. So if you have a good plan year, that plan retains that money and builds ballasting and reserves for that company over time. Effectively, you're cutting a large portion of the insurance company's capital off and keeping it for yourself and for your people and the people that you fight with every day, your employees. You fight for them and you want to protect them. This protects them longer term. So, short run, fully insured is easy, and then it's also shorter term in value. Level funded is harder, kind of middle, and it's better mid-term. So 1 to 7 years is better, period. Self-funded, I really wouldn't go below 100, guys. But if you want to do self-funded with claims volatility, it's hardest. You need a good CFO, and it's the longest term value. Anyway, those are the three big categories. There's also truly self-funded. But if you're listening to this conversation and you need this information, folks, you can call me, but you shouldn't be running a 10,000 person health plan if you're not able to handle this. So these are the three big ones that are going to affect you. Fully insured, it's a black box, easy button. Level funded looks from a financial standpoint like a fully insured bill, as it's the same amount each month. You're pre-funding your claims account. And then self-funded with stop loss, there is no pre-funding of the claims account, so you might have cash calls. Those are the big differences. I'm sure that there's some experts out there that have been doing this as long as I have that are going to say, Tom, technically this is that. I would love to hear about it. Please put it in the comments. I love this kind of stuff. If you're out there fighting for Main Street, like, subscribe, stick around. And if you need to fight for one of your clients to get another case that's in the 5 to 100 range, level funded, we're here to help. All right, we'll see you out there.